What's up, HyperFast Nation? On this episode of the show, we've got a repeat guest. In fact, he's been on many episodes. Uh, the one and only Karl Svendsen, loan officer extraordinaire, and we are getting an update on all the crazy stuff that is going on in the world of mortgages and how it could impact you as a real estate agent. Welcome back to the show, Karl. Karl, welcome back. How have you been?
I've been doing great, Dan. Grateful for where we are right now, and glad to be back.
Yeah, it's been a few months since you've been on the show last, and not much has changed in real estate and mortgages since then, probably, right?
1 month can change a lot.
Yeah,
Just as far
yeah.
as
That was my
big.
attempt at a joke. So
So, yeah, the Fed meeting here this September, uh, not a whole lot changed, but the comments that they made really impacted the stock market, the mortgage rates, and the mortgage rates really based on the what we've seen with the 10-year Treasury, the T-bills. So I guess the main takeaway from the meeting was that the Jerome Powell came out and said that they're expecting rates to stay higher for longer, and higher for longer really spooked investors. And that put a lot of people in position where they started investors dumping more money into the T-bills, which then rose the yield on the T-bills. And that negatively impacts mortgage rates. So, I mean, in a span of 1 month, the mortgage rates are, for most people, usually about 0.5% higher now. And we try to stay optimistic here for everybody in the market, because you're going to have more success if you have more of a positive attitude. I mean, we want to live in reality, but you want to stay positive overall. And we're in an environment now where, I mean, you can see some articles I read recently here that economists with Bank of America came out and said that we might see a 5% yield by the end of the year on the T-bills, which would be insane.
yeah,
I mean,
we
we
just
just
hit four
crossed the
point
highest part.
six, right? 4.6 we just hit, which highest in 15 years.
Yeah, so
And
if
I
we
think I
crossed
think
over
last time I
five,
think last time you were on the show. Sorry, I keep cutting you off. It's just the problem with not doing these in person. But last time you were on the show, I think we were at like in the 3.5 range or so, and so
mhm,
yeah, a lot has changed.
yeah. If we cross five, that'd be the highest that we've seen in over 20 years. And I think the all-time high is like the 5.3 and some change. So
Hmm.
definitely getting into some soon to be unprecedented territory.
Well, and at this to dive more in this Fed meeting, they said probably one more rate hike for this phase of the quantitative tightening, right? And that I think was expected, so that wasn't a surprise. But then I think they changed some of the language on the things they were monitoring, and then I think another thing is that they maybe pushed off how long it might be until we see rate cuts, right? So they're saying one more hike maybe by the end of the year, and then the cuts might not come till June, and maybe only two next year, and that was a little bit of a change, I think, and certainly more of a change. When you go back to the beginning of this year, people were saying like the cuts would start at the end of this year. Some people, so yeah, things have changed.
I think it's going to cause more short-term pain for people in
Right.
real estate and just the overall economy. But long term, I think it's going to benefit everyone from an economic standpoint. And the reason I say that is because when I talk to some clients on a high level about the market right now, my take is that the economy is half broken right now. And the way that the Fed handles everything over the next 6 to 12 months is super important to prevent the economy being completely broken. And what I mean when I say broken is, right now we have high inflation and high interest rates. But the last thing we want is for them to start cutting too soon and then we're in an environment where we still have high inflation and we have low rates and we're in a recession, then you pretty much put yourself into a box where you may not be able to really fix it without there being some significant negative impacts.
Yeah, they're in a pickle, I guess. Do you think we've seen like peak mortgage rates, or do you think they're still going to go up more?
No, I think that there's still opportunity for things to get a little worse before they get better.
Yeah.
But thanks for bringing that up, because I think in that same breath, because first lien mortgage rates are not tied to the Fed rate, they're tied to the 10-year Treasury, the stock market performance, unemployment, mortgage-backed securities. All those different factors impact mortgage rates, and it's not just the Fed rate. We may see some improvement on mortgage rates before they start cutting, because inflation, along with all those other items, inflation's the primary driver for mortgage rates. So with them keeping rates higher for longer, it should stifle inflation more, and data lags. So it's going to take a little while for us to get more inflation data that's going to show that inflation's tamed. And we're probably going to get that data before the Fed starts doing rate cuts. That's what they're looking for to start before they start cutting. So we may see some improvement in mortgage rates a month or two before we start seeing Fed rate cuts.
Are you thinking we're getting to the point too where some of the big months of inflation from like a year ago are going to start to like drop off, and that in a couple months we might see levels closer to 2, or what's your take on that, on the inflation?
I think we're ways away from touching 2.
Hmm.
Some people with some adjusted lag numbers are saying that we're really closer to or just under 3 at this point. But I think I've been saying for the whole course of the year that because of how high the numbers were in October and November last year, those 2 months are 2 months of big opportunity for us coming down the pike here shortly. So if we stay on the track that we're on now, then there is a huge opportunity for us to see some better data come November, December, when we can replace those October, November numbers from last year. But there's some things that are unpredictable that can skew the data. We saw in August the biggest thing that kind of skewed the data was energy costs and oil costs. So energy really skewed the overall inflation numbers that we got in August. If those hadn't gone up in the capacity that they did, then it probably would have been a win. So, I mean, that's kind of the difference of looking at headline inflation versus core inflation numbers.
Yeah, the energy, I think, cost was definitely something that was not expected and made a big impact. I think the other kind of interesting thing that we mentioned before the show actually was, the Fed is going to be looking at jobs data, and it's not the unemployment data, jobless claims, and all of that look good from the point of like not indicating we're in a recession. But then, I think after that number came out, then they revised what was a good number like 6 months ago. So it's almost as if like sometimes the number comes out and then a few months later, some people in the department figure out like they didn't calculate this right, or this data was bad, and now all of a sudden the number is not what they thought it was.
Yeah, and that's huge that you bring that up, because when you get 6 months down the line, that's not going to be a market mover anymore, because people either aren't going to pay attention to it, or it's essentially aged so much at that point where people don't. It's not going to change how investors move their money and the overall outlook on the economy. They're going to continue to look at the most recent data that's come out. So. And I mean, we see that, we've seen that for years. They always go back and do revisions as far back as a year, I think is the farthest back that they go. So hopefully the numbers that we get in, over the coming 6 months, hopefully those are a little bit more in tune with where we actually are. So that way that's going to drive mortgage rates to a better position. The higher the unemployment goes, the better that is for mortgage rates.
Yeah, it's interesting with a year ago or 6 months ago, 3 months ago, we wouldn't have thought it would like get worse. We thought it would be getting better, and like a lot of realtors were using the tagline like, uh, marry the house, date the rate, and that I'm sure over time that will pan out, but it's almost as if maybe now you say like get buy the house before mortgage rates are at 9.
Perspective is everything. I was talking to a client earlier this week that closed a year ago, and I would have never thought a year ago that their rate in the high fives is a pretty good rate compared to where we are now.
Yeah.
So yeah, perspective is everything, and it's really impacting. I think from what I'm seeing in my business, it's impacting first-time home buyers the most because with the higher interest rates, it's just less affordability. Investors aren't really impacted, especially if they're putting a large amount of money down, because it's just all pure numbers. There's no emotional component to it, and there are solutions for those buyers where they can qualify for a loan product regardless of what the numbers look like. It's just a matter of it making sense for them. Whereas with first-time home buyers, somebody now that can qualify for 700,000 would have qualified for $1 million like just 3-4 months ago. It's pretty drastic.
What kind of things are you telling real estate agents to do right now to help their buyers navigate these times and help them to have more confidence?
Yeah, I mean, it's all circumstantial to what their target audience is. I think right now, with how much ever, there's a lot more people on social media now than there were, just a couple years ago, let alone 5-10 years ago. So I think it's really important to get hyper focused, to use one of your words, on one particular segment. So that way, you have a niche. But once I know what your niche is, that's when I can kind of better assist you with what's going to be more advantageous for your buyers. So I mean, first timers is a completely different segment than move up buyers. It's a lot easier right now to provide solutions for the move up buyers because they have existing equity in their current home that they can leverage, either with a bridge loan, or we can talk to them through how a recast works after closing. And so in those situations, I just had somebody on the team last week in this scenario where the buyer plans on selling their house after they close on the new one. And they have the ability to put the money down, so they don't need a bridge loan, but they are going to take the money from selling their house and throw it at the mortgage after when they sell their current place. And we know what those numbers look like because we've asked the right questions. We've gone through a full buyer needs analysis, and we're equipped with all the information we need to be able to walk the buyer through what it's going to look like after they do the recast on their mortgage after they close on their existing home. So what we did is we told them, hey, this is what your monthly payment is going to look like as soon as you close on the house. But let's look forward. Once you do the recast, this is what your monthly payment's going to look like once you do the recast. And then, I just asked the buyer, what their outlook is on interest rate. Do you think it's crazy that interest rates may be 1% better a year from now? And then if they give me the no to that, no, I don't think that's too crazy. Then we give them the monthly payment of what it will be when they refinance to a 1% lower rate. And that was the difference, walking them through looking towards the future, being proactive, and having that foresight of what you're going to be in store for later on. That was a payment that he was comfortable with, and it was a couple $100 difference on the interest rate difference, but that's the difference of him making a decision to make an offer or not.
Yeah, no, that's a great point. I think I think you have to really be problem solving, consultative, ask really good questions, and as a real estate agent, I know the agents at least that work with you, they have another problem solver on their side, right? Like whether it's providing solutions for first-time home buyers or move up buyers, like you just talked about. Like you're really good at like helping the agent dig in with the buyer and figure out the perfect solution for them. So I appreciate that. Love the updates you gave us today. And I'm sure we'll do another one of these in a few months and see where things are. If people want to connect with you or you know learn more about how they can work with you, how should they do that? How do they follow you or get in touch with you?
Yeah, shoot me a text at 804-665-4344, and we can hop on a call, talk about what you're seeing in your business, and be able to provide you solutions. I think that,
All right. What was that number again?
yeah, 804-665-4344.
All right. Well, thank you so much for being on the show today, Karl. To all of our listeners and viewers, thank you for tuning into this episode of the HyperFast Show. Please leave us some comments, feedback, hit the subscribe button, share with other real estate agents that you know, all that good stuff, and we will see you next time.